Are you curious about the stock market but feel overwhelmed by all the jargon? You're not alone. Investing doesn't have to be complicated or intimidating. In this quick guide, we'll break down the basics of the stock market in simple terms, so you can confidently start your investing journey today. Whether you want to grow your savings or build long-term wealth, it all begins with understanding the fundamentals, and we got you covered. Let's dive in and make your money work for you. Today we will talk about stock market for total beginners. Start investing today. So before we start, make sure to hit the like button and subscribe to my channel. 1. Stock market for total beginners. Start investing today. Investing in the stock market might seem like a daunting task for total beginners. With terms like bull market, dividends, market capitalization, and portfolio diversification thrown around, it's easy to feel lost before you even begin. But the truth is, investing in stocks can be one of the most effective ways to build wealth over time, and anyone can get started, regardless of their background or experience. This article will walk you through everything you need to know to begin investing confidently and wisely today. 2. What is the stock market and why should you care? At its core, the stock market is a marketplace where shares of publicly traded companies are bought and sold. When you buy a share of stock, you're essentially buying a small piece of ownership in that company. As the company grows and earns profits, the value of your shares can increase, allowing you to sell them later at a higher price or earn dividends, a share of the company's profits paid to shareholders. The stock market is a vital part of the economy because it provides companies with the capital they need to expand while giving investors opportunities to grow their wealth. For beginners, understanding this concept is the first step toward realizing how investing can help you achieve financial goals, like buying a home, funding education, or retiring comfortably. 3. How does the stock market work? The stock market operates through exchanges, the most famous being the New York Stock Exchange, NYSE, and NASDAQ. Companies list their shares on these exchanges through an initial public offering, IPO, making their stock available for public trading. Investors use brokerage accounts to buy and sell these shares. Stock prices fluctuate based on supply and demand, which in turn are influenced by various factors, such as company performance, economic conditions, geopolitical events, and market sentiment. It's important to remember that stock prices don't just go up, they can go down too, which is why investing requires patience and a long-term perspective. 4. Different types of stocks and investment strategies. Stocks come in several varieties, each carrying different levels of risk and reward. Common stocks give you voting rights in a company and potential for capital appreciation. Preferred stocks generally pay fixed dividends but don't usually come with voting rights. Additionally, stocks are categorized by market capitalization: large cap, well-established companies; mid cap, and small cap, smaller companies with higher growth potential but more risk. For beginners, one popular strategy is to start with blue chip stocks, large, reputable companies with a history of stable earnings. Another approach is to invest in exchange-traded funds, ETFs, or mutual funds, which pool money from many investors to buy a diversified portfolio of stocks, reducing risk. 5. How to start investing. Step by step. Starting your investing journey involves a few simple steps. First, educate yourself on basic financial concepts and how the stock market works, which you're already doing. Next, choose a brokerage platform. Today, many online brokers offer easy account setup, low fees, and educational resources perfect for beginners. Once your account is ready, decide how much money you want to invest. Start small if you're unsure, and $50 or $100 can be a good starting point. Then, research stocks or funds you're interested in, considering factors like company health, industry trends, and long-term potential. Remember, avoid hot tips or trying to time the market. Steady, consistent investing tends to yield better results over time. 6. The importance of diversification and risk management. One of the golden rules in investing is diversification, spreading your investments across different companies, sectors, and even asset classes to reduce risk. Think of it like not putting all your eggs in one basket. If one investment underperforms, others may perform better, balancing your overall portfolio. For beginners, this is why ETFs and mutual funds are especially attractive. They provide instant diversification with one purchase. Alongside diversification, risk management means understanding your own risk tolerance. Younger investors might tolerate more risk for higher returns since they have time to recover from losses, while older investors may prefer safer, income-generating investments. Always tailor your portfolio to your financial goals, timeline, and comfort level. 7. Common mistakes beginners should avoid. Many beginners jump into the stock market without adequate preparation, leading to common mistakes that can hurt their returns. One major mistake is emotional investing, buying when prices are high out of excitement or fear of missing out, and selling during downturns due to panic. Another is lack of research or blindly following trends without understanding the fundamentals. Trying to time the market by predicting short-term price movements often backfires. Additionally, neglecting to set clear financial goals and failing to create an investment plan can lead to poor decision-making. By staying disciplined, focusing on long-term growth, and continually learning, beginners can avoid these pitfalls and build a solid foundation for successful investing. 8. Long-term benefits and next steps. Investing in the stock market is not a get-rich-quick scheme, but with patience and consistency, it can be one of the most powerful ways to grow your wealth. Historically, the stock market has averaged annual returns of about 7 to 10% after inflation, outperforming other asset classes like bonds or savings accounts over time. Starting early allows your investments to benefit from compound growth, earning returns on your returns, which can dramatically increase your wealth over decades. Your next steps should include setting up a regular investing habit, such as monthly contributions, continuing your education on financial literacy, and reviewing your portfolio periodically to ensure it aligns with your goals. Remember, the key to successful investing is to start now, no matter how small, and let time work in your favor. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.